Have you ever asked yourself how much investment risk you're comfortable with? This question brings us to the concept of risk tolerance, a critical aspect of financial decision-making. Risk tolerance is all about understanding your ability and willingness to withstand potential fluctuations in the value of your investments. It's like your financial personality, defining how much investment uncertainty you can comfortably live with. But why is it important? Well, understanding your risk tolerance helps align your investment strategies with your comfort levels, financial goals, and capacity to endure market volatility. For instance, if you're someone who can't stand the thought of your investments taking a dip, you'd probably lean towards more conservative investment options. On the other hand, if you're comfortable with riding the market waves for potential higher returns, you might opt for riskier assets. In essence, risk tolerance is a compass that guides your investment journey, keeping you within your comfort zone and on track towards your financial goals. Risk tolerance ties closely to your financial goals and the time you have to achieve them. Let's unpack this. You see, the nature of your financial goals and the timeline set to reach them significantly influence your ability and willingness to bear risk. For instance, if you're saving for a short-term goal, say a dream vacation next summer, you'd likely have a lower risk tolerance. You wouldn't want to gamble your sunny beach getaway on a high-risk investment, right? On the flip side, if your goal is more long-term, like planning for a retirement that's several decades away, you could afford a higher risk tolerance. Why? Because you have more time to recover from any potential losses and benefit from the potential gains of riskier investments over the long haul. So you see, your financial goals and their timelines play a pivotal role in determining your risk tolerance. When it comes to risk tolerance, your mindset and financial resilience matter. Let's delve into the psychological aspect of risk tolerance. It's not just about numbers and charts, but how you feel about these numbers. Some investors are emotionally resilient, comfortable with the roller coaster ride that certain investments can offer. Others, however, may prefer a smoother journey, choosing more stable, conservative options to avoid emotional stress. But that's just half the story. Equally important is assessing your capacity for loss. This is where your financial circumstances come into play. Consider your income, expenses, and other financial obligations. What would be the impact of potential losses on your overall wealth? Could you weather a storm, or would a financial setback throw you off course? These are not easy questions, but necessary ones. Because at the end of the day, your psychological comfort and financial capacity for loss are key determinants of your risk tolerance. Managing risk involves spreading investments and understanding the risk-return trade-off. Diversification is the investment equivalent of not putting all your eggs in one basket. It's a strategy that involves spreading your investments across different asset classes such as stocks, bonds, and commodities. This approach can soften the blow of poor performance in any single investment, helping to align your portfolio with your risk tolerance. Now let's move on to the risk-return trade-off. This concept acknowledges a fundamental principle in investing. Higher potential returns often come with higher levels of risk. Think of it as a balancing act. On one end of the scale, you have the allure of high returns, and on the other, the potential for significant losses. Your risk tolerance is the fulcrum upon which this scale balances. So striking a balance between risk and return, and diversifying your investments, can help align your portfolio with your risk tolerance. Risk tolerance isn't a set-it-and-forget-it concept. It changes, and so should your investment strategy. Over time, various factors such as life events, changes in financial circumstances, or shifts in market conditions can alter your capacity to withstand risk. Hence, it's crucial to regularly reassess your risk tolerance to ensure your investment strategies align with your current comfort levels and financial goals. Investors often fall into three categories based on their risk tolerance: conservative, moderate, and aggressive. Conservative investors prefer safety over significant market swings, while aggressive investors are willing to tolerate more risk for the potential of higher returns. Moderates, as the name suggests, fall somewhere in between. Then there's the role of an emergency fund, a financial safety net that can bolster your risk tolerance. Knowing you have a backup can provide the confidence to accept a certain level of investment risk. Regularly reassessing your risk tolerance and maintaining an emergency fund can help you navigate your investment journey with confidence. Understanding risk tolerance can be complex, but you don't have to do it alone. In fact, it's often beneficial to seek the counsel of financial professionals. They bring a wealth of knowledge and experience to the table and can provide insights that you might not have considered. Moreover, they can help you navigate the intricacies of risk tolerance, from assessing your capacity for loss to understanding your psychological comfort with volatility. Financial advisors use a variety of tools, including risk tolerance questionnaires, to gauge your comfort with different levels of risk. They can help you articulate your financial goals and time horizon, and then tailor an investment strategy that aligns with your risk tolerance. Importantly, they can also help you reassess your risk tolerance over time, ensuring that your investment strategy remains effective even as market conditions change. Professional guidance can lead you to a better understanding of your risk tolerance and help you make informed investment decisions. Risk tolerance is a multifaceted concept that serves as a foundation for your investment decisions. We've traversed the terrain of risk tolerance together, understanding its close ties to your financial goals and time horizons. We've touched upon the importance of assessing your capacity for loss and your psychological comfort with market volatility. We've explored diversification as a strategy to manage risk and the risk-return trade-off that governs investment decisions. We've underlined the need for regular reassessment of risk tolerance, especially in response to life changes and market shifts. We've delved into the different risk profiles, conservative, moderate, and aggressive, and how these can shape your investment approach. We've emphasized the reassuring role of an emergency fund and the value of professional guidance in comprehending and applying these concepts. In essence, understanding your risk tolerance can empower you to make confident, informed investment decisions that align with your financial goals and comfort levels.